Welcome, everyone. I'm Mary Brown Sands, Chief Marketing and Communications Officer at the Small Business Investor Alliance. The SBIA is the Association of Senior Investment Professionals focused on the lower middle market, whose members represent the entire private capital ecosystem. It is an alliance for professional fellowship, business opportunities, innovation, regulatory expertise, and market data. SBIA works on behalf of its members as a tireless advocate for policies that promote competitive markets and robust domestic investment for growing small businesses. SBIA has been playing a pivotal role in promoting the growth and vitality of the private equity industry and the small businesses it supports for over 60 years. We're pleased to bring you our Lunch and Learn webinar series with today's topic, Evolving Debt Financing Terms. Our educational webinars are designed to provide valuable content for our members, industry colleagues, and when the topic is relevant, the management teams of investor-backed portfolio companies. If you have questions for our speakers during the webinar, please use the questions feature in your GoToWebinar menu bar. We will monitor this section and share them with our panelists. Any questions that are not addressed during the presentation will be answered soon after today's webinar. Also, please use this feature to let us know if you are having technical issues. Today's technical director, Ainsley Hoffman, will reply with suggestions. Please note that this session is off the record. Comments, statements, and materials are for the express use of SBIA members and are not to be published or recorded without approval by SBIA and the professionals at Locke. Today's session is possible because of the support of our silver sponsor, Locke. The professionals at Locke represent SBIC's mezzanine, senior debt, venture, growth, and buyout funds and their portfolio companies. The firm services clients ranging from Fortune 500 and middle market public and private companies to startups and emerging businesses on a broad range of investment transactions, litigation, fund formation, and regulatory matters. Locke operates globally out of 21 offices around the world and has received numerous industry recognitions as a global leader in the middle market sector. Today, we welcome Tamara Tallgren, Marisa Murillo, and Jonathan Young. Tamara's practice focuses on representing private equity and venture capital firms, SBICs, and other investors in equity and debt investment transactions, fund formation, and regulatory matters. Tamara has significant experience advising SBICs on investment, regulatory, and fund formation matters, and he frequently represents banks in connection with financing provided to SBICs. Tamara also counsels growth-oriented technology companies and middle market businesses on M&A and financing matters. Joining Tamara, we welcome Marisa Murillo. Marisa's practice centers on representing lenders and borrowers in senior and junior capital financing, leverage acquisition financing, and working capital facilities. She has served as lead counsel to middle market senior and mezzanine lenders in negotiating and documenting complex financing transactions, including secured and unsecured credit facilities, commitment papers, subordination and intercreditor agreements, debt and equity restructurings, and working capital facilities up to $500 million. She has also negotiated and closed numerous senior secured facilities for private equity sponsors with commitments up to $1 billion. Finally, we welcome Jonathan Young, co-chair of Locke's Bankruptcy, Restructuring, and Insolvency Practice Group. Jonathan regularly advises investors, lenders, directors, equity sponsors, and portfolio companies about their rights and obligations relative to financial distress, insolvency, and bankruptcy. He also counsels trustees, receivers, and other fiduciaries charged with reorganizing, restructuring, or liquidating financially distressed entities. While he has handled clients in a range of industries, he has particularly substantial experience in private equity, advertising and media, technology and telecommunications, life sciences, audit, accounting, and insurance. Tamara, it's my pleasure to turn the virtual podium over to you and your team to get us started.
Great. Thank you very much, Mary. I'm very happy to be here and happy to be with my colleagues, Marisa, who is normally sits next to me a couple doors down in our Chicago office, but now, we speak to each other in our homes. And I know what furniture she has, which is always kind of interesting. And Jonathan is in our Boston office, although he has spent some time in Chicago, many years actually. So we all know each other very well. And now I know some nice artwork that Jonathan has on his wall, which is very nice. So I'll just kind of give an overview here of how we're going to do this. Marisa is a debt finance expert, as Mary just went over the bio. Jonathan focuses on bankruptcy, restructuring, and related matters. We all work together on transactions and matters. I'm going to act as a moderator here because what we're focused on is really what we do kind of on a quarterly basis internally and with clients, which is to examine and provide updates on what we're seeing in terms of business terms and legal terms, focused on the legal side of it, of course, with respect to credit agreements, loan transactions, and with respect to restructuring and distress situations as they become relevant. I guess one thing I would say as well before we start, one of the benefits we have is in our practice, and I'm more of a private equity and SBIC and mezzanine focused attorney. So I do play in some of these areas, but one of the benefits I think that we have when we're doing these is our firm within our debt finance group and our private equity group. We represent a lot of lenders as well as borrowers on credit facilities and loan transactions. And on the lender side, that would include banks, SBICs, debt funds, and the like. And then on the borrower side, we have a long-standing private equity practice where we represent the funds as well as the portfolio companies on the borrower side of these transactions. And Jonathan on the restructuring and bankruptcy has for many years worked with our private equity clients on these as well. So we think that our viewpoints are fairly, we see both sides. So we're getting input from on the borrower side as well as the lender side. So with that being said, and the other thing I'll mention is we do have slides here. I think we're going to try to do this where we're going to kick off with the first slide, which provides some statistics. But then since we're going to do this as a panel discussion with myself as the moderator, we're really going to move off the slides and just make it a bit more interactive. And if we need to refer to slides at some point, we can do that. But that's the idea there. So, okay, so Ainsley, if you could go to the first slide, please. Okay, so we have some stats here. The one I'll focus a bit more on is the William Blair Middle Market Survey of Middle Market Lenders for Q2. So this had, to me, it was, I assumed there was going to be trends in this direction, but I was actually, it even surprised me as to how strong the responses were. So 94% increased pricing for primary debt offerings, 92% tightened transaction terms. These are the lenders, middle market lenders talking. 80% wanted minimum equity contribution from sponsor, 35% or more. 94% did not make borrower-friendly concessions to win deals. We have a stat at the bottom here. This is really, you know, on the bigger side of the market, Moody's ratings downgrades. So not as applicable to what we're talking about today, but instructive to kind of see what's going on in all areas of the market. So ratings downgrades have been happening. And I guess before I segue into my first question, I'll add the kind of the color that we are focused here, even though our firm, we do through all phases of the middle market, I would say upper, middle, and lower. We're focused on this conversation really in the middle and lower middle market, although we'll provide some data points on the upper, just because of the audience. We think with SBICs and others in SBIA, that would be most relevant. So I'll kick it off to Marisa first. I guess, first of all, Marisa, were you surprised to see these stats, the William Blair numbers, or is this pretty consistent with what you're seeing?
Yeah, I think this is definitely consistent with what I'm seeing. you know, I am was curious, or would be curious, I think, for people on the phone as well, to stay on top of what's going to happen or what's recorded for the end of Q3. But I definitely think it's a tighter credit market right now, especially on the borrower side, and that lenders are being a lot more conservative in terms of what they're requiring from sponsors and issuing new term sheets and commitments.
Yeah, and that's probably a good segue to a follow-up, which is maybe looking at it from the lender's side. Any maybe generally first general responses in terms of how they're viewing it, whether with respect to credit standards or general terms you're seeing?
I definitely think lenders have instituted tighter credit standards, at least temporarily. And I think there's some concern that we'll get to points about this later, but for existing borrowers or people with existing credit that sort of move to draw on revolvers or take immediate actions at the beginning of the pandemic, I don't think lenders want to have a bunch of credits outstanding that have that similar activity going on. So definitely a different market. You know, it'll be interesting to see how the rest of the year rounds out.
Mm-hmm. And I guess from the borrower side, similar question, any general views or strategies being taken or how they're looking at things due to, you know, in the last 6 months or the last quarter?
It's different, right? Depending on what industry the borrower's in, I think there are different conversations happening with lenders. Some industries, of course, have been really struggling in 2020, but definitely borrowers need to keep the conversation open with lenders, because even for borrowers that were able to get amendments done in the spring, now they may be looking at extending those amendments or modifying terms even more. And so I think they have to stay in regular communication with their lenders. And Jonathan, I don't know on the restructuring side if you're seeing more conversations between borrowers and lenders as well, but.
Very much, Marisa, and it's driven by a couple of things. You know, from a borrower loan party perspective, it's kind of a terrifying time to, you know, take assets to the market. Valuations are going to be very depressed to the extent you're dealing with a business that is valued on any kind of revenue or EBITDA based multiple. You know, it's not going to be a number anybody's going to like very much. And on the lender side, there's a lot of uncertainty right now in terms of enforcement. I mean, if you are a secured lender that's looking to foreclose upon a position, there are all kinds of limitations and moratoria on going to court to do that. So I think over the past 2 quarters, there's been a lot of incentive for borrowers and lenders to frankly buy time, hope that things improve, figure out a way how to manage intervening liquidity, and perhaps make some governance improvements in the interim, chief restructuring officers and the like. As we move into Q4 and into the next year, it's going to be interesting to see whether that patience continues or whether, you know, we're going to see lenders forcing the issue.
And are those moratoria and things that are incentivizing the conversations to occur, are those explicitly temporary, or are they potentially extending out for the foreseeable future?
I think it's been, Tamer, I think it's been a series, it goes jurisdiction by jurisdiction, and it's been a series of, I think, 2-3 month extensions. I mean, I think it's important to remember that's for court proceedings. A secured lender can always exercise remedies out of court, you know, do a UCC sale, or some kind of out-of-court process. But to the extent there's any kind of valuation dispute or a need to get court assistance, it's very difficult right now to do that. And when you add the valuation challenges, I think it has made lenders somewhat reluctant for many credits to pick the fight. I think what ultimately may tip it back the other way is we're seeing a lot of businesses and a lot of industries where the liquidity challenge is so great and the cash burn so substantial that the lenders are facing bad options in either direction. I mean, if they foreclose or enforce, it's uncertain and may not be a very good recovery. On the other hand, if it's any kind of revolver-based facility, that cash burn is potentially causing over-advance scenarios and potentially digging a deeper hole for the lender.
Yeah, that is very interesting and certainly something that we're seeing. I mean, Marisa, in terms of maybe that last topic on with respect to liquidity and the cash burn, I mean, are you seeing that affect the way borrowers are making decisions with respect to their lending relationships or vice versa?
Yeah, so if you remember in March, and Ainsley, I may ask you to scroll to slide number 4. When we didn't know where this pandemic was going, there was a rush in March to actually, that if you move forward one more, I think that's, yeah, there was a rush by borrowers to draw on their revolvers, maxing those out, pulling on incremental debt under their credit facilities. That was specifically because people thought that the repercussions of the pandemic were going to last maybe a quarter, maybe a little bit longer, and so they took immediate action. There's still, though, this overarching need for liquidity under these credit facilities. So some borrowers are holding on to cash. They're holding on to cash, whether that's through the revolver and keeping that cash on hand, whether that's through asking for exceptions to mandatory prepayments. And so we're still seeing the repercussions of what borrowers did in March and April to get more cash on their books. So yeah, liquidity is still very much an issue. That has not changed. The summer didn't really make things better. And I'm not sure how that's going to change between now and maybe the election or the end of the year. But that's definitely something people have top of mind.
And how are lenders viewing that? Has that evolved, or I guess, what are you seeing in terms of their views and responses to those sorts of actions or requests?
Lenders are instituting at different stages a few different responses, right? But we are seeing some anti-hoarding provisions where they have, it's sort of like the language you'll see in an over-advanced scenario, where the borrower, if they go above a certain exposure level on their revolver, lenders will ask for a repayment of outstanding revolver debt within a period of days, 3 days, 5 days, a lot like an over-advance. And so we're seeing more of that happening. There were some interesting deals that I saw in preparing for today, where there were also term out features where if the revolver was still in place at some point in in a period of time, whether that's 12 months or longer, lenders would give the option of converting that to some kind of term facility. And Jonathan can speak a bit to, in addition to borrowers exercising these options to keep liquidity, 2020 has been an interesting year for borrowers trying to figure out how to reconfigure some of their collateral. And we've gotten to see some deals with these, what we're calling collateral stripping issues.
Well, thank you for the segue, Jonathan. Do you want to touch on that? That would be great if you could.
Yeah, I'd be glad to. And just really briefly on the prior point, I think it's been interesting in this cycle to see that lenders who have rather tight documents and fairly strong discretion as to whether and when to over advance have nonetheless been over advancing, and they've been doing it because the outcome of a forced liquidation looks so awful. So there's of course the rights under the facility and the documents, and then there's the accommodations the lender makes just to try to maximize the recovery. And there have been some very uncomfortable decisions lenders have had to make where they've over advanced into a very troubled situation, but they do so to try to maximize the chance of a going concern valuation or some kind of going concern transaction with the prospect of getting out at par. And I think those are very difficult decisions indeed. With regard to the collateral stripping or trapdoor trend that Marisa referenced, again, like so much in this cycle, it's really driven by the search for liquidity. And what we've seen in a number of credits are very creative and enterprising borrowers and loan parties finding new liquidity in their balance sheet, often at the expense of senior secureds or other priority parts of the capital structure. And what we've seen in cases like J. Crew and PetSmart and Travelport and Serta Simmons is we've seen borrowers and loan parties use their permitted disposition baskets, their unrestricted subsidiary rights, their assignment rights, and they've rather creatively in these scenarios used those provisions to move valuable collateral out of the senior secured collateral position and into another part of the capital structure where they can create some new liquidity. So, for example, in J. Crew, there was a transfer of the so-called crown jewel IP and brand assets to a non-loan party restricted subsidiary that then made an investment in an unrestricted subsidiary. PetSmart involved a very valuable e-commerce brand being transferred to an unrestricted subsidiary outside the loan party structure, and thereby cut off the recourse or guarantee obligations of that entity. Serta Simmons was a situation where they did a debt for debt exchange and ended up subordinating a group of non-consenting lenders. Now, as we move into this cycle and lender terms tighten, I think there's going to be all kinds of effort made to close those trap doors and eliminate those risks. But there have been a number of these situations where senior secureds have just seen really material portions of their collateral go out the door to benefit somebody else. It's resulted in liquidity for the borrowers and it's resulted in litigation. But the really fascinating thing is, in all of these efforts, there was a plain language interpretation of the credit documents that let them do it. So we'll have to see how all this litigation plays out, but it's awfully tough to attack a transaction when it's a transaction executed in accordance with the plain language of the credit facility.
Yeah, and in some ways that is kind of reassuring if you haven't been in one of those situations, because you can structure around it. I guess the fact that this has happened maybe more frequently in recent years, is that due to loosening of covenants that we've seen, in the past several years, and as the pendulum swings back, it's kind of a fairly easy remedy thing to do on the lender's side.
Yeah, very, very much, Tamara. I mean, I think a substantial majority of these strategic maneuvers have really focused on the interplay between unrestricted subsidiaries or affiliates that are kind of outside the loan party structure, and then these permitted disposition or investment baskets where there's a certain level of transaction activity that you can engage in, free of some of the other restrictions of the facility. And when you put those two things together and you add to them, your general assignment rights, there are abilities under some of these older facilities to really move the valuable assets around the balance sheet in ways that have led to some pretty surprising results. I do think to the extent you're tightening up, you're tightening up the baskets, you're tightening up, what you can do with an unrestricted subsidiary, you do solve for the risk. But, these cases are very much a function of a cycle where borrowers had a lot more negotiating leverage and were able to leave a lot more play in the joints in terms of what they could do.
Right. Yeah. Marisa, I want to go back to something Jonathan said about this topic, and maybe more specifically, lenders kind of having to over advance even though they realize that it's not the best situation, just due to the fact that they're already in the deal, they're in the credit. I mean, are you seeing, apart from the liquidity issues in terms that we talked about, other terms or covenants where lenders are kind of having to make those sorts of choices, whether it's things related to specifically the pandemic or otherwise?
Yeah, definitely. For some recent deals that I've seen where we were in forbearance mode, lenders may have been very, you could predict the things that they're going to block through the forbearance. But I do think I've seen lenders be a lot more forgiving in timing for a sale process, if that's part of the plan for the forbearance, on delivery of any kind of financial information, if that's part of the forbearance. So there definitely are ways that lenders are making concessions, and they're doing those things for a longer term. I'm seeing forbearances with different lenders last for a lot longer than you would expect, because they want to give people breathing room to figure out an exit strategy or a plan for refinancing. So those things are pretty interesting right now. That is not like the recession of 10 or so years ago. So,
and in terms of, I guess, maybe covenants, are you seeing a similar thing where lenders are rejiggering things and being kind of willing to do that, or any specific terms or provisions that you're seeing more, whether either in amendments or new loans in that regard?
yeah, so if we could scroll forward one more slide, there are a few things that we highlighted or found as a group that were definitely new terms or more common terms that we're seeing in amendments that are coming out of the pandemic. In particular, the things that we're finding a lot of movement on were MAE definitions. Excuse me. In some instances, lenders were willing to make carve-outs to the MAE definitions with respect to COVID-related events. Those carve-outs were sometimes time-specific and may cover some period of time, 150 days. You know, at first it was 90 days, but now we're seeing as long as 150 days, sometimes through December 31, 2020. That's definitely something we're seeing more in large cap deals or large or middle market deals, but it is something that borrowers are pushing for. I mentioned earlier that we're also seeing financial covenant holidays. Companies are struggling to meet their leverage covenants. They've been struggling for a couple of quarters now. Lenders are giving them holidays on financial covenants, sometimes with additional reporting, sometimes with reporting that looks a little bit like a forbearance with budget, you know, weekly budget reporting and different items like that. Information delivery, quarterly reporting, audits, those things have all been off for 2020. So lenders are giving more time on delivery of financial statements. I don't think it's necessarily a question of whether auditors can perform these audits remotely, but I think it's more a question of what these different financial reports are showing about recent performance and whether or not that can be remedied near term.
Mm-hmm. Yeah, I was going to say just quickly, the MAE definition is an interesting one, and I think it kind of shows somewhat of a bifurcation between what the large cap deals will agree to for borrowers, because in the middle and lower middle market, you know, we aren't really seeing lenders agree to that, but as happens, you know, this happens in cycles. We do often see those, you know, certain provisions get kind of pushed down over time from the upper end of the market down to the middle and lower middle market, but haven't seen it specifically yet, but it's interesting to watch for that.
Yeah, and that's an interesting one, right? Like, I can remember a few years ago when or maybe it was last year, a year before, where we were moving to even lighter covenants, and I wouldn't call it quite covenant light, but lenders were getting a little bit more relaxed with some of their borrower standards. There were not always MAE reps or a bring down of MAE that could be an event of default. Recently, those had started to come back. So this probably depends a lot on what's in your document. Do you have an event of default that's triggered by an MAE? Do you have reps where you bring down the MAE every time you draw? So those are things to look at within the credit documents.
Yeah. I was just going to ask, because I see on this slide a reference to PPP, and you know, there have obviously been entire presentations done on PPP, and I mean, it actually was my life for a couple of months, and I'm glad we're kind of past that. But I guess in terms of, well, we're not past it. That's kind of the point. In terms of how the existing PPP loans, the, you know, PPP borrowers that have lenders separate from that, how does having a PPP loan, what effects has that been having with respect to relationships with their other lenders, their secured lenders?
So many people took PPP money. So at first, I think borrowers thought there was some kind of stigma attached. Now I think people are starting to deal with it in a process that's a little bit more routine. So PPP obligations we saw in the spring and summer were typically treated as permitted debt. Sometimes they were carved out of leverage, but those things were tied to other covenants on forgiveness, applying for forgiveness within a timely period, you know, doing everything above board with respect to SBIA certifications and reporting and payroll obligations. Now we're seeing that forgiveness period has been pushed out. So borrowers have gone back. Some of the borrowers that we had worked with have gone back to their lenders asking for additional time on, you know, some of these different carve outs that were done for their PPP debt.
Mm-hmm. Yeah, it's just fascinating how many issues have come out of the PPP program. In terms of, are there, any specific, things in terms of effect on covenants that that you're seeing, or provisions in loan documents for the borrowers that have PPP loans that have to be dealt with?
Just the same, more reporting, more transparency with the lender, especially if the lender in the credit facility is not the one that issued the PPP loan. Really, real pressure to submit forgiveness applications so you can move that PPP debt off of the balance sheet, but that process is not moving very quickly from what we're hearing.
Yeah, can I stop you there for a second, just because we talk about this a lot. We probably haven't talked about it in a couple of days. Have you seen any forgiveness being accepted yet? I haven't.
No. Mm-mm.
Yeah. Okay. And I guess we would be remiss if we didn't at least briefly mention that there was new guidance that came out last Friday from the SBA on a very hot topic, much awaited, regarding PPP borrowers and in change of control transactions, whether it's a sale of the PPP borrower of equity or of the assets of the PPP borrower. And prior to the guidance coming out, there's obviously thousands and thousands of these companies that have PPP loans out there. The rule that was applicable to if you're doing a sale of a PPP borrower came from the existing 7A SBA 7A program, which predated the PPP. The PPP is kind of one subpart of 7A, so it wasn't tailored to PPP in any way. And so the general rule was that if you're a borrower that has a PPP loan, you have to get the lender's consent to the change of control. The lender under the 7A program rules has to get the SBA's consent before it can give you consent. And we were seeing, it varied, but previously we were seeing 3 to 4 weeks, sometimes quicker, a week or two, to get that consent in these transactions for borrowers that had PPP loans. There was guidance that came out on Friday that now applies specifically to the PPP for change of control. In some ways it's helpful, but it certainly was not what people were hoping for. I can probably say on all sides. Essentially what it does is, if you're selling more than 50% of your equity or assets, you don't have to get SBA, or the lender doesn't have to get SBA consent, as long as you submit a forgiveness application prior to closing, and you put into escrow held with the lender in an interest-bearing account, which, if you get forgiveness, would also be forgiven. But you'd have to put that into escrow, apply for forgiveness, and then you wouldn't have to get SBA consent. I think there are a couple interesting things about it that aren't so helpful. One is it somewhat appears that before you could either get SBA consent or you could structure around it in the transaction. Here, it seems like you can, getting SBA consent isn't necessarily an option anymore. If you want to do it, you have to provide a justification as to why this escrow and applying for forgiveness scenario isn't feasible for you. We'll see. There's very little detail about kind of the standards of that, whether you can still try to get SBA consent or not. And the other interesting thing was, any transaction which involves greater than 20% of the equity being sold counts as a change of control. It doesn't mean you have to get consent, but at the closing of the transaction, if your deal is selling more than 20% but less than 50%, you have to, within 5 days, disclose to the SBA the deal and then certain things about the deal, which certainly was not a requirement before. So, but to be fair, some helpful things here. not having to get SBA consent in certain aspects. But like everything with PPP and outside of PPP, strings attached and additional complexities. So I don't know, if, Marisa, have you seen this come up? I mean, it only came out Friday. Have you seen it come up? I'm working on a few deals that kind of are midstream, and so having to pivot. And it's not going to crater deals, but it's just kind of restructuring things a little bit to comply with the right.
Yeah, my sense of it was that there were a lot of transactions. If you can scroll forward, Ainsley, to slide 7. So this is the slide right here, that there were always big question marks about certain pieces of the PPP. So again, I think when people are looking at their amendments again for now through the end of the year, there is still the shifting SBA guidance and delayed timing. These escrow agreements now are like what I've seen since Friday's guidance is people asking me now, we've got this escrow agreement, what does it mean? The SBA guidance on Friday required that if there was an escrow agreement, the PPP lender had to have the ability, some kind of control mechanism through that escrow agreement. I've had people asking me, what does that mean? What does this mean for this particular escrow agreement? What if your PPP lender is not the escrow agent? It's definitely an interesting time. Jonathan, I don't know if you have any thoughts on it, but.
Well, just one footnote from a bankruptcy perspective. Shortly after the program was launched, there was some guidance suggesting that Chapter 11 debtors were not eligible for PPP funding. And it was really controversial because the reasoning given was that it was too great a financial risk for the government to be extending this credit to a Chapter 11 debtor. And for those of us who practice in the restructuring and bankruptcy space, that was kind of backwards. Someone's actually much more stable a week after filing a bankruptcy in most instances than a week before, because they're not having to service current debt and they're in a forum where they can either do a transaction or restructure the balance sheet. So what happened was a bunch of Chapter 11 debtors filed suit against the SBA and said this is just irrational lawmaking. And ultimately, there were a series of decisions rendered. The courts were hopelessly conflicted about it. And I think right now it's kind of quieted down because I think at this point the SBA is letting companies who filed bankruptcy get the loans. But there's still a lot of question marks about what happens if you got the PPP money and then you filed a bankruptcy. And as you both pointed out, we've still got the whole forgiveness process yet to come, and how will the bankruptcy factor into the forgiveness? So it really needs to be emphasized that, I mean, all of us are figuring this out day by day as we go, the government included. So I think there's really an element of how do we make the whole PPP and government financial assistance process fit a fast moving and complicated Chapter 11. And I think we'll get some of those answers in coming months.
Yeah, that the issue of if a PPP borrower already has a loan and then goes into bankruptcy and how the forgiveness works there. I mean, to me, that issue is going to be so, I mean, it is becoming, it's going to be so prevalent because clearly the program, they put out a lot of money, which helped a lot of businesses, but it clearly didn't get all businesses. It wasn't long enough or sustained enough for a lot of businesses. So there are a lot of businesses which are going to go through that process and have a PPP loan. It seems to me that the fact that you're going into forgiveness, or the fact that you're going in bankruptcy, should not disqualify you for forgiveness. To me, I don't think the regulations say that, but they also, it's just not clear at this point. So it would just seem like a travesty to somehow say that, okay, these companies that received a PPP loan because they were financially distressed won't get forgiven if they go through that process. But maybe it depends. But I guess you get in the question of who's really benefiting from that in bankruptcy.
Yeah, well, you have competing considerations. I mean, the whole purpose of the program is to save jobs and stabilize portions of the economy. But like any government program, they're also trying to make good underwriting decisions and to protect the taxpayers' money. So I think what we're really witnessing in real time is watching the government try to balance those two factors. And I would say a company that goes into Chapter 11, takes PPP money, and actually comes out the other side with a going concern transaction or a restructuring is doing exactly what the program had in mind. It's saving jobs and it's stabilizing a business. But whether we get to that outcome in some of these cases, that remains to be seen.
Yeah, very, very interesting stuff. I guess in terms of, we're kind of talking about trends and things in this new world where some of us are working from home and deals are getting done in different ways. Maybe I'll start with Marisa. Are you seeing trends in terms of, or trends or complications or issues in terms of how deals are getting done?
Yeah, definitely some interesting things happening. There's a push now to beef up this electronic signatures and electronic communications language. We have done that even in smaller agreements. Sometimes lenders have to consent if it's just an older credit agreement form that didn't contemplate some of what we're doing now. Jonathan spoke earlier to some of the enforcement issues that we're seeing in different jurisdictions, court closure issues, and Jonathan, I'll let you speak to that. Enforcing some of these obligations is getting a bit trickier now that everything's remote, and we're under some certain government orders and different restrictions. So
yeah, I just want to jump in before Jonathan. The one thing you mentioned, Marisa, was the electronic signatures and kind of getting more clarity about that. I have to say, interestingly, maybe not counterintuitively, in some ways. So I'm in the process of closing a deal. It's a sale of a company pursuant to a merger, and the company has like 90 shareholders and option holders, all these different parties. The fact that everybody now is very well versed and knows how to use DocuSign very well, the closing and that aspect of the signature and closing process has actually been easier and much quicker than it was before. There's all sorts of other delays and things that now come up in deals in terms of not being able to travel and just overall delays in other aspects. But I certainly have noticed that this, which normally would take much longer, is now taking a much shorter period of time. I think in large part because everybody's just so well versed and comfortable with DocuSign and e-signature. So that's been pretty interesting, actually.
Yeah, there are some things that have been pretty good, right? The electronic signatures part is pretty nice. Some lenders are not requiring people to come back and deliver a whole host of originals. So some transactions were closing and that's it. And then you get your closing book in some kind of Dropbox, and that's fantastic. Some of the negotiating has gone, for me at least, it's gone a lot better because everything's happening sort of virtually. People are making time to do it. Some of the apps that we're using, like Zoom, have these share screen features, and when you're like, I don't like some provision in a loan document, you can just share screen and show it to somebody, which is pretty fantastic as far as I'm concerned. So it's not all bad. And there are very few jurisdictions where there are any issues at all with the electronic signatures. We've done a little bit of diligence for some different clients on where there might be some issues, and there are very few states now where you have to have an additional layer approval, but these parts of working from home, they have been better than the, traveling, better than requesting originals, better than some of the formalities we used to have.
So what I'll say is, aside from the fact I missed the two of you terribly, is I think it's about 80% of the experience of being there in person. It's pretty good. I think you're right. I think we've all gotten pretty fluent in it. And I think we're able to get a lot done and be productive. If I could touch briefly on financial advisors before lawyers, because financial advisors in my space are critical. And, either from a borrower or lender perspective, when a company is really entering a difficult stretch, it is a huge help to put boots on the ground at the company. And, we work with a pretty wide range of financial advisors and chief restructuring officers, and they are 90% remote, 95% remote. I mean, they're occasionally going in, but not too often. And, if you have a borrower that either has operational problems or governance problems, or even perhaps some problems with the financials, there's just no substitute for having someone there in person talking to employees, vendors, customers, and the like. So we're all making do, but we are to some extent flying blind from that perspective. In our practice, I would say the remote interaction is very good generally when you're proceeding on a cooperative basis. It's pretty good for complex negotiations. And it's okay for court hearings where you're basically making legal argument. I think where you are at the toughest part of a negotiation and you need to kind of work through the last 2 points, when you're in a trial or a tough hearing and you really need to watch how the judge is physically reacting to the things people are saying, again, I'd use the term flying blind. We just can't fully see everything that's going on. So I'm proud of all of us. I mean, I think, we are largely doing what we need to be doing, and we're getting our work done. But I am not in the camp that thinks we will be Zoom forever. I think there's an important piece that we're missing, and I'm eager to get back to it.
Yeah, I want to speak to a couple of things that you're raising some good points, Jonathan. That from a transactional perspective in getting to a deal, I'm seeing that there is some difficulty with respect to due diligence, or where the lender doesn't have an ongoing relationship with the borrower or the sponsor, and they have to diligence, they want to meet people. They would normally have traveled to have some of these meetings. That comfort level is not always there. So sometimes I'm seeing even diligence taking a little bit longer, or lenders asking for a whole lot more information, a little bit more skepticism than if we had the ability to travel and meet with each other in person. And I think that's also, in addition to kind of the market effect, that's also trickling to things like credit approvals, or where you amend the terms of a deal after term sheet, and maybe you have to go back and get a second layer of approval. Some of this is not happening so easily because people don't have the ability to meet in person, and that comfort isn't there. So.
Yeah, it is definitely a new world. So I think, we have 5 minutes left. If anybody has any questions, we can take questions. I think if you shoot us a text through the GoToMeeting app, we can see that. If not, maybe we can go to kind of concluding remarks, but I'll pause to see if there are any questions.
Yeah, I don't think any new questions have come in. So Marisa, Jonathan and Tamara, thank you very much for this valuable and timely conversation. We appreciate the expertise that you have so graciously shared with us today. A replay of today's webinar, along with presentation materials, will be distributed to SBIA members and will be available on our website at sbia.org, where you can view previous webinars and materials as well. Our next Lunch and Learn webinar is Tuesday, October 20th, and will feature a discussion on acquiring companies with outstanding PPP loans. In addition to the SBIA webinar series, we hope that you will participate in one of our upcoming fall networking events. SBIA is hosting golf and pickleball networking events around the country. These small group outings are open to non-members and are a great way to connect in person in a safe, friendly setting. Please visit our events page at sbia.org for details. And while registration is now closed for this year's virtual Capital Links, please be on the lookout for future announcements. SBIA's Capital Links is a strategic matchmaking platform that introduces institutional investors and lower middle market funds and provides an exceptional networking opportunity for GPs actively fundraising or going to market soon, and for LPs looking for new fund managers to invest in. Stay tuned for future details on Capital Links program. Finally, if you're not an SBIA member and would like to learn more about joining our organization, please contact my colleague, Alex Frick, at 202-628-5055 or by email at membership@sbia.org. Thank you again for participating in our webinar today, and we look forward to having you join us on the 20th.
Bye, thank you.
Thanks so much.
All right, good job, very good job.